All right, so we're going to get started. It was 1992. That's when Gene Fama and Ken French published their paper, The Cross-Section of Expected Stock Returns. That paper really changed the way we think about returns in finance and the way we organize asset classes. I mean, it really revolutionized the way we think about things. It's also become one of the most cited papers, if you think about it, in the financial literature in the area of finance. It also kicked off what I call an arms race of factors. This arms race of factors has been documented by Campbell Harvey in a paper called A Census of the Factor Zoo. In that paper, as of his latest update, which I think was through January of this year, he had cataloged in academic literature over 400 different factors. In his paper, in his words, he says, the production of factors in the academic literature has gotten out of control. So if you think about it as advisors, how do we make sense of this menagerie of factors? Well, with us today, we have two special guests. We have Marlena Lee, Head of Investment Solutions at Dimensional, as well as Holly Framstead. She's the Head of U.S. Factor ETFs at Blackrock. They're going to help us make some sense and share with us the way that they think about these factors. I've asked each of them to take some time to come up and explain the way they view factors and implementation at each of their firms. After that, we'll open it up to questions from the audience. So with that, Marlena.
Thanks, Sheldon. Thank you. Okay, so Sheldon did ask us to talk about kind of which factors and how do we decide on, out of all of this zoo of factors, how do we decide which ones to pursue, how do we decide to pursue them. And I didn't mean to make the picture even more complex for you guys, but I would say the question has to extend beyond just which factors. It's also, why do you expect to see them? And how do they behave? How do they interact with other factors? When do they show up? Where do they show up? All of those additional questions all go into deciding which ones belong in your portfolios, how best to pursue them, how to mix them together. So it is quite an in-depth topic. Unfortunately, we only have 15 minutes to talk about it, so I'm going to try and make it quick. How things show up is of particular importance. So I'll give you a quick analogy or a quick story to bring that one to life. So it was 2 weeks ago, I was in London visiting our London office. And typically when I go to London, I like to take the Saturday night red-eye flight there so that I can have all Saturday to get used to the time zone, to get a fresh start on Monday morning. And let's be really realistic, it's so I can hit a whole day of shopping on that Sunday afternoon. So one day I landed, I just took a quick shower, and then I headed out, and I saw on the map, I just had to turn left. And I thought, okay, I also decided to be really cheap that trip, and I didn't sign up for an international plan on my phone. But I just thought, okay, I'm just gonna head left, and everything will be okay, because I kind of know the direction of the hotel. So a couple hours of shopping later, I decide I need to start heading back the way I came. And it was 17,000 steps later that I decided I had no idea where the heck I was. And the reason for that, it wasn't sufficient for me to know just the general direction of where I needed to be heading. I needed to know in much more details which streets I needed to take. So how does that relate to this slide in particular is that there are some premiums that will occur over a very long horizon. Those are the things that are all the way on the long-term column there. So things like size, value, which is relative prices code for value premium, and profitability are things that tell you about expected returns over many, many, many years. In other words, if I form a value portfolio, it will capture the value premium over multiple years. But that's kind of like just knowing I generally need to head west. But if you want to pursue high expected returns, then wouldn't you like to also know if the premiums are going to take you for a detour? Right? Wouldn't you rather have a detailed map that will show you how to also get high expected returns in the next, say, couple of months? That's where we have some of the short-term factors there, where things like investment, which I will talk about more, things like momentum, or even the information contained in securities lending prices. They actually contain information over a few months to a few weeks. It's useful if you want to buy a security and you're managing a portfolio on a daily basis and you say, well, I want to buy a security. Well, wouldn't it be great if you could know that it has high expected returns, not over the next 5 years, but also over the next couple of months? It would be a much better security to purchase than one that would have maybe great long-term expected returns, but in the shorter term, it might take you for that detour because it actually has really poor short-term expected returns. And then even in the next second, wouldn't it be great if we could figure out how to implement a solution so that even in the next second, we're not harming our expected return profile? That has to do with how you go into the market to trade. So the idea of if we want to buy a security, how do we make sure that it has high expected returns over the next 5 years, over the next month, over the next second? That's what I want to talk to you about today in the next, I think I might have 13 minutes now. So one part of how you choose a premium is why do you expect it to be there in the data in the first place? As an investor, the worst thing you can do is look at a pattern in historical data and take it as a prediction of the future. Because there's probably, of that hundreds of different factors, there's probably a bunch in there that were just data mined. And therefore, it's because you have hundreds of researchers pouring through the exact same data, they're finding patterns that weren't actually there, and therefore are not going to be there for you in order to get your clients to their investment goals in a more successful way. How do you best try to protect yourselves from pursuing data mined results? Having a good reason to expect something to be there in the first place is one way that you shield yourself from that risk. So I want to give you a rationale for why you should expect at least the first 4 premiums on this slide. So size, value, profitability, and investment. Investment there is just a company that is investing. So it's growing its assets, but it's much more than just growing its assets. Think of a company there that's going to double its assets over a year period. So let's look to a different type of asset class in order to build our intuition around these premiums. So let's say you have a client that's looking to invest in real estate. He wants to buy, or he or she wants to buy a rental property. What is the *1 consideration you might want to look at or advise your client to look at when it comes to investing in real estate? A rental property. Location, location, location. That is not going to be my answer. And why? Because prime real estate also comes with what? Prime price tag, absolutely. The location is actually embedded in the price. So what do you tell them? Cash flow. Okay, so we heard 2 things. Okay, so first, for a given location, you want to be cognizant of the price. Okay, there's a few different ways you can do that. So you might have an absolute price. For this location, don't spend more than $1 million. You might have a relative way of doing that. Per square feet. You want to target something that's less than $200 per square feet. Something like that, right? But in terms of those types of price metrics, what are you looking for? High or low prices? Low prices, right? But you might be willing to pay a higher price for something if it has attractive future cash flows. This is a rental property. What's its rental profile going to be? Now, what if you have the client that says, okay, I found this great place, it's a bit expensive, but I think that it's going to have great rental income. And then you actually find out, no, you actually can't rent this thing out for the next 5 years, 10 years. Is that a good investment? No. Because what do you want in terms of cash flows? Positive cash flows. Okay, one last hypothetical. Great rental income. All of that rental income goes into maintenance, HOAs, taxes. What is it telling you? It's not a good investment. Okay, you just told me that you expect size, value, profitability, and investment premiums when you take that exact same analogy and put it on stocks. Okay, so the absolute value, that's just a market, that's just size. Price times shares outstanding, it's market capitalization. You want a low price, you want a small cap security relative to a large cap security. Price per square foot. Okay, now we just need to divide the price by something. We like to divide it by book value, not dimensional. There's lots and lots of research why we do it that way. But then you want something that has a low relative price. That's a value security relative to a growth security. You want great cash flows. And you want great cash flows that accrue to the investor, not just great cash flows at a gross level. So the two things there you need to account for are the cash flows from a stock. They are sourced from company profits. But sometimes the company keeps those profits and reinvests it into themselves. So that's like the property with great rental income, but all of that rental income then gets plowed back into the property as maintenance costs, HOA, things like that. So what actually accrues to you as the investor is much lower. That's investment or high asset growth. All of these things are related to returns in both theory, and the theory, I should use quotes, because it really is just this idea that you want to pay a low price and you want to get high cash flows. That's the theory that I'm talking about. But out of that theory comes these variables should be related to returns, and in the data we see that it is. But the how is it is also important. You'll notice that even with the same framework, I explain size, value, and profitability and investment all in one framework, but the investment's hanging out there in a short-term bucket. That's because if you if you look at the investment premium, it tends to go away by about 2 years. So unlike a small cap strategy or a high profitability strategy, where you might have turnover of, let's just say, 25%. In other words, on average, those stocks in those portfolios will be in there for 4 to 5 years, so multiple years. Now we're looking at something that's much shorter term. Because it's much shorter term, in order for it to not turn over your portfolio really fast, you have to treat it differently. So I want to encourage folks not to go through all of the, I mean, we were looking at the investment premium for years, actually. Not to go and do that research on your own, but know that when it comes to efficient execution, when it comes to implementing these factors, it goes beyond the which factors. It also goes to how are you implementing it. Investment's actually a little bit longer than momentum. Momentum decays somewhere between 6 to 12 months, which then requires even faster turnover to pursue that in a really active way. In other words, by buying past winners. The reason why you need to be cognizant of these things is because there's something else that counteracts that premium, and that something else is called trading costs. So the more you have to turn over the portfolio, the more potential trading costs. In our study of momentum, mutual funds, and ETFs, we found the vast majority of them did not capture the momentum premium. They actually underperformed the Russell 3000, even in a period where the momentum premium was positive. I will say that one of the ones that did beat the market was the iShares one, so I'll just give that one to them. But we did find that the vast majority of momentum mutual funds were not able to do that. And that gives us pause for, okay, we're not totally sure if it's going to overcome its trading costs. So let's handle it a little differently. Same thing with securities lending. So securities lending, you do want to consider the benefit of the actual lending revenue. So in 2018, across all of our global lendable equities securities, we added about 11 basis points into the fund return. Okay, so that's a return benefit to those funds. But in that process, we get to see how much are people willing to pay in order to borrow these securities. If someone's willing to pay a really high fee in order to borrow a security, presumably, perhaps, maybe, to short the security, then why is it that they may want to do that? Could it be because they have some information that that stock is going to underperform? And that's exactly what we see in the data. But the thing is, when you see something with a high fee, the predictive power is very short, right? We look out to about 2 weeks. So how do you use information in expected returns that is just such a short-term nature? You have to handle it differently. You can't handle all factors, all premiums the same way. In the case of momentum and securities lending, what we do is instead of forming a portfolio around that particular piece of information about expected returns, we use it as a point of trade decision. Hey, portfolio managers, if something has down momentum, it's going to have short-term poor returns relative to something that has up momentum. We want something that has great long-term return characteristics and great short-term return characteristics. So if you have a broadly diversified bucket of securities, overweight those with those short-term good characteristics, overweight those with up momentum. So that's just a difference in how you might want to pursue a premium depending on how it behaves. And then the last little piece here is intraday. So in the next second, how do you try and get those trading costs as small as possible? Okay, and the way we do it at Dimensional is we think it's very important to have a daily process. Let me point out 2 benefits of the daily process. So our portfolio managers will look across, take into account all of this information plus more, and generate what do they want to buy today, what do they want to sell today. Right? The information here are things that change daily. Right? Prices change all the time. They're giving us new information about expected returns all the time. You want a process that moves as fast as the information that is coming in order to really effectively point the portfolio to higher expected returns. So let me give you, I wish I had a whiteboard, but I don't. So let me still give you the example that I would write on the whiteboard. But remember how I said a high turnover strategy for Dimensional is something like 25%. Okay. I'll give you a back of the envelope way to estimate. Here's how you can kind of back out what's the expected loss of premium from not having a daily process. So let's just say you have a strategy that you expect to outperform because it's pursuing higher expected returns. 2% a year. Make a bet. It's a random number. You can stick in whatever number you want. 25% turnover divided by 250 trading days. That means each day, the part of the portfolio that's sitting outside the expected 2% outperformance range will be about 0.1% per day. In other words, by the end of the year, you've got 25% of the portfolio sitting outside. 25% times 2%, 50 basis points loss if you've got an annually rebalanced portfolio. If you want to know that number for a quarterly rebalance, just divide it in half. 12 and a half. I didn't actually do that math just now. So that's one thing, is you want a daily process in order to be able to pursue the premiums every day. But you also want a daily process so that you can go into the market with a really light footprint. So at Dimensional, we talk about participating, not initiating. So that's how you can go in and make sure that you're keeping your trading costs as low as possible, not cross spreads. And we certainly have both our internal trading cost analytics as well as third party indicating that our trading costs tend to be much lower than like a median peer. So that's one way you make sure that you're keeping your expected returns even in the next second as low as possible. I know that I'm going a little bit long, but Sheldon did want me to mention kind of ETFs versus mutual funds. Now I'm going to place active ETFs over to the side because, let's be honest, they account for a really, really small segment of the market. The vast majority of ETFs will be an indexed ETF, and therefore rebalancing once a year, quarterly, depending on the rebalancing schedule. And then the main benefit that we hear is that you have some tax efficiency associated with an ETF over a mutual fund. And we'll see some data that that's absolutely the case. Many ETFs out there distribute zero capital gains, but then I would indicate that there's much more to tax efficiency than looking at capital gains. So one way to measure the total tax efficiency of a strategy is to look at its tax cost ratio, so just how much do your clients receive of that overall return number. So in a post-tax but pre-liquidation basis, when you look at most of the largest ETFs relative to a dimensional fund, you're looking at a number that's in the mid to high 90s. So very high tax efficiency associated with dimensional funds, on par with most ETFs, for example, from Vanguard or iShares. In a post-post basis, so post-liquidation, post-taxes, there you're looking at a number that tends to be somewhere in the mid-80s, so lower to mid-80s, that is going back to your clients after they sell the position. So in terms of tax efficiency, what we see is that by having a very well-diversified approach, very low turnover, and by having just having tax awareness in how you manage the portfolios, then you can achieve similar tax efficiency ratios within a mutual fund as what we see for an ETF. With that, thank you very much, and I'll turn it over to, do I turn it back to you? Or?
To Holly.
To Holly.
Thank you.
Thanks, Wendy.
Well, I have to say, you'll notice as I flip through my slides here, when Marlena and I both submitted our slides and we got a copy of what each other was presenting, she had, I think, 3 slides there, and you'll notice that I think I have 9 disclosure slides. So we're at opposite ends of the barbell, though I think we'll talk for the same amount of time, just I might have a few more clicks in there. So pardon all of the required disclosures, it's almost comical. I guess the good news is for you, now they make us put them at the beginning so that you actually do see them. So I was asked to talk a little bit about Blackrock's philosophy for factors. We may be a newer name than Dimensional. We have tons of respect for what Dimensional has done. But I would say we're a newer name in recognition, not in the length of time that we've been implementing factor and systematic strategies. So I'm going to talk a little bit about our firm, our philosophy, how we think about factors, which you'll notice is not dissimilar to Dimensional's process, and the scale and efficiency then that comes with the implementation through ETFs. As a firm, we have been investing in factors for decades. In fact, about the same amount of time as Dimensional, and you'll notice that it ties with research. So both of our firms were founded with strong academic bases, and as a result, as research around systematic strategies started to pick up, our firm began to innovate. We didn't call them factor strategies, they were just our scientific active equity strategies at the time. We called it alpha back in the 1980s and the early 1990s because at the time it was actually quite hard to capture these premia. And investors were willing to pay more for a strategy that simply screened based on value characteristics, as an example, because access to that data was very hard to come by. As the years have evolved, the research has progressed. We've seen the addition of not only size and value investing, but the addition of quality in the early 1990s. Blackrock follows Richard Sloan's research that came out in 1996. We've also seen the introduction of risk parity strategies, and then in the about mid-2000s, the introduction of ETFs. For us, bringing these factor-based strategies into ETFs wasn't a big statement that the ETF is the best way to go. It was simply a natural evolution, that as we've seen a democratization of access to data and analytics and technology, and as we have seen investor preference for a vehicle that is liquid, trades on exchange, has transparency, and has delivered tax efficiency, we simply packaged the strategies that we had always had for institutional investors into a structure that we could bring to the rest of our clients in a 1940 Act product. And so as we talk about the evolution in ETFs, we have partnered with MSCI as an index provider for a lot of our strategies, quite simply because we believe that they're able to deliver to us a very good, solid index, and by being index-based, we can bring it in an ETF structure and deliver that with tax efficiency. So when we talk about this evolution, know that it's part of the ethos of our firm and how we've been investing for decades. And our partnership with MSCI is really a function of having the right product and having the right exposure to be able to deliver at the price point that our clients are looking for. When we think about factors, I think one slight difference between the way that Blackrock implements factors and some of what Dimensional does, we've actually engaged quite a bit on this topic, so I know that our philosophies are a little bit different here. We believe that factors transcend equities. In fact, to be a factor for us, it has to be broad and persistent, and by broad we mean span across asset classes. So while we do believe that value and equity is critical, it's a mainstay of products that we bring, we also think that you can find value and quality in fixed income securities. We believe in carry as a factor, not in long equities, so you won't see carry as a factor that I talk about through much of this presentation, but carry is very important when we talk about currencies and when we talk about commodities. And so we believe that the capture of factors needs to span beyond just a single asset class for it to truly be something that is worth investing in. And that is because that is the indication to us that this premia is something more than something spurious that you're seeing in the data. We have 4 criteria that actually sound incredibly similar to Dimensional's criteria for determining what we are willing to call a factor. So how do we combat that Cam Harvey dynamic of 400 factors in the written literature when we're thinking about funds to bring to market or investments to implement in our clients' portfolios? For us, a factor has to meet all 4 of these criteria, and the upper left one, economic rationale, is the most important. In fact, as we think about implementing research at Blackrock, the first step has to be understanding why the data that you're seeing might be indicating what you're seeing. And not only understand what it's showing you about the past, but be able to extrapolate in a very intuitive way why that anomaly is likely to persist into the future. Because if you can't do that, then you can't prove that you're seeing anything other than a really good back test. So economic rationale is critical, and I'll talk through the economic rationale of a couple of the factors that we view perhaps a little bit differently than value and size. Second is value creation. Not surprising to any of us, it has to actually add value in the portfolio. Most importantly, diversification. In order to consider something a factor or a rewarded factor, a dimension of higher expected returns, as Dimensional would call it, it needs to be fundamentally different from something that we already deem a factor. So a really great example here is dividend yield. We don't believe that dividend yield is a rewarded factor, simply because it's not different enough than value. Price to dividend is actually a value indicator, and so while it can add value in a portfolio and is incredibly important to many clients who are seeking income in their equity investments, it's not distinctly different enough, so we don't consider it a unique factor. Finally, efficient implementation. So we'll touch a little bit on how implementability in a portfolio is critically important. Clearly, if you can't implement the research in the real world and still deliver excess returns, then it kind of doesn't matter what you've read in that white paper. With those 4 criteria in mind, talking about the long equity market, there are 5 factors that Blackrock believes are rewarded. The top 4 are rewarded in absolute return space. So you should expect higher returns as a result of investing in value, quality, size, and momentum. We also believe in minimum volatility, though it's important to point out that that is a risk-adjusted returns anomaly, meaning you can get higher returns than you should expect for the amount of risk that lower vol securities introduce in the portfolio, or rather the amount of risk they don't introduce. But you should expect returns in line with the market over the long run in an investment like that. In the environment that we've seen the past couple of years, investments like minimum volatility are critically important, because I would propose that the number one challenge that advisors that I'm talking with on a daily basis face is not necessarily what do we think the market's going to do in the next 2 years or 5 years. It's how do I keep my client invested because they're ready to sell out of the markets. And your job is to keep them invested for the long run. And what minimum volatility has enabled a lot of our clients to do is smooth that experience out and simply keep their clients invested in equities when they're ready to run for the doors. Especially in a low interest rate environment, it's an incredibly important dynamic that is real that we all have to deal with. Okay, so let's talk a little bit about economic rationale, because it's incredibly important to understand why a factor has worked. I'm assuming that everyone in the audience here is very familiar with the rationale behind value and small cap investing. Value in particular being rewarding you for, in a lot of ways, that cyclicality risk. What we're all feeling right now in the long drawdown of underperformance for value is perfectly normal and within the realm of expectation that that will happen. In fact, that's what you're being rewarded for. So we believe that for investors who are in value, staying the course makes sense. That is a long run rewarded premium. But let's talk about minimum volatility because I think it's a little less intuitive. In fact, for investors, and many of our clients are focused on the price that they're paying for securities, the concept of buying something that on average is more expensive than the market is a little counterintuitive. Minimum volatility stocks tend to drive higher risk-adjusted returns because they're capturing not a reward for risk, but a structural impediment in the market. And that structural impediment leads to behavioral anomalies that might be outside the realm of normal, except when you consider the impediment. That impediment is limits to leverage. So if you think about most of your clients, and in fact, many institutions as well, they have a limit to the amount of leverage they can take. So let's say you're bullish on the stock market and equally bullish on a 0.8 beta stock and a 1.1 beta stock. You're trying to deliver higher returns for your client. Which security do you buy? You buy the 1.1 beta stock. You think the market's going up, both stocks are going up, you will buy the higher risk stock because you would expect a higher return as a result of that. Now, if you think the market might go down, certainly you want to consider the risk embedded in there, but all else equal, you would choose the 1.1 beta stock over the 0.8 beta stock any day, unless you can take leverage. Because if you can take leverage, you can lever up your 0.8 beta investment to a return profile that's the same as the 1.1 beta stock. The problem is if you can't take leverage, and most active managers can't, in their 1940 Act products, take leverage, they're all expected to deliver returns, they buy higher risk securities. And as a result, they pay more than they should for higher risk stocks and forget the lower risk stocks. Now, this doesn't mean low risk is less expensive. It does tend to come at a premium to the market, but it's introducing less risk in the portfolio, so it should have a higher premium to the market. And as a result, minimum volatility strategies can deliver higher risk-adjusted returns than high-risk stocks because they are undervalued for the amount of risk reduction they contribute. Unless we expect limits to leverage to go away, that phenomenon is not going to end. And so as a result, we expect that that will continue to persist. That's economic rationale. The same can be said for momentum investing. There have been a lot of studies and a lot of theories for what drives momentum. But it all really comes down to this fear of missing out. And for any client who has had equity markets up 20+% this year, how come I'm not? You understand that at its core. In fact, we see more strategies benchmarked to the S&P 500, even though it's an incredibly inappropriate benchmark for many of them, simply because that's what our clients, that's what my dad sees when he turns on CNBC. I mean, I can't tell you how many times, as a side note, people say, oh, do you know where the Dow is at? And it's like, well, what does that tell you? I was an index portfolio manager, and whether the Dow's at 10,000 or 20,000, it's only relevant if you know what it was at yesterday, because all I care about is the percent change. So we see that investors are constantly inundated with data that may or may not even be relevant to them, and that's what they're paying attention to. And again, back to your biggest challenge, keeping your clients invested, well, this fear of missing out is real. And so as a result, many investors will chase returns, and they will continue to chase returns. And this pile-on of momentum, as Marlena said, tends to continue for about 12 months. So stocks which have been trending for 12 months tend to trend for about another 12 months before they reverse. Unless we expect everyone in this room and every one of your clients and everyone who's not even a client of yours but maybe day trading stocks like my chiropractor to start behaving more rationally, momentum is going to continue. So these are just a couple of examples. Obviously, we have economic rationale or beliefs behind the economic rationale for all 5 of these, but this is why we don't believe that Cam Harvey's 400 factors are really a problem, because not all of them, in fact, most of them don't have this rationale that allows us to believe they'll persist. The second criteria was value creation. So here's just an example using the long-only indexes that our ETFs track to show that on average, over long investment horizons, all have added value. It should be no surprise to any in this room. Momentum is on this list. It has added value, and our portfolio tracks this index incredibly closely. So even after transaction cost of implementation, we've been able to deliver on that premium. The challenge is that factors are inherently cyclical. And again, anyone who's invested in value is feeling that. Value and size work best in the early stages of an economic growth end of the cycle. And you have to be invested at value near the bottom to capture that premium. So maintaining investment throughout the cycle is what allows you to capture that upswing in value and have those long run excess returns. But as we head toward the later stages of the cycle, where we're at right now, is really where you see quality and minimum volatility take over as dominant drivers of return. What this tells me is maybe you could time it if you were really good, much like you could probably time sectors. I mean, some people are effective at that. It's incredibly hard and it's costly to do, but perhaps you could. Or perhaps you could just think differently about diversification and invest across the spectrum of the economic cycle in factors that are rewarded. Because if all are rewarded over the long run, and they're rewarded at different times and in different ways, then they achieve our third necessary component to be a factor, diversification. And that's what you're seeing right here. We've taken single factor indexes here and had a combination that is just value and size, and then a combination that includes all four of them. And what you'll notice is, importantly, the ride is a little bit smoother. It's not positive all the time. It certainly doesn't experience the extreme ups in 2009-ish that value had, but it is experiencing more consistently positive returns. And again, back to investor behavior, smoothing the ride tends to ease conversations and tends to lead to better long-run investment results. Because the biggest risk to you, I would propose, is not that your clients have 0.5% less of return on average annualized over a 15-year investment horizon. It's actually that they have you sell out of equities at the depths of the financial crisis because they're too scared and they miss the upswing, and this isn't the return profile they experience in the first place. And so by smoothing the ride, by having greater diversification, we believe that it can help clients stay invested longer. And then finally, efficient implementation. So we talked about the fact that all of these factors in long-only form have delivered excess return. The ETF structure is one where we get a lot of questions, so I included this slide just to address the fact that when you have something trading on exchange, a lot of the people who have some fear about ETF trading versus mutual fund trading will talk about the fact that you're going to the exchange and you're putting in an order and you don't know what price you're going to get. I would propose that liquidity matters. So when you look at the bid-ask spread, so that's the price that you pay when you buy a share of one of our funds or you sell it in the market, bid-ask spreads which are tight, average daily trading volume which is large, coupled with fees, expense ratios that are low, creates a total cost of ownership profile that's incredibly affordable for clients. And if you pair that with capital gains, which can be a #1 detractor from client performance over time, is the distribution of capital gains and needing to pay those taxes, then what we find is that the ETF structure can be incredibly efficient. But I'm happy to answer questions on this. I know ETFs are something that are gaining steam, and there's been a lot of articles in the news lately, so happy to take any questions that you want in terms of the efficiency of ETFs. But at this point, I'll let you get into questions.
Thank you. So we do have time for questions. If anyone has a question, you can step up to the mic there, ask your questions. I've got one question I'll start off with while we wait for people to line up. I just want to address the elephant in the room right away, which is underperformance. You know, it's something, when you talk about factors, we've seen it specifically valued small for a long period of time. Marlena and Holly, how do you address underperformance with clients, and how do you get clients to stay invested through those cycles?
I mean, I think Holly said one of the most important things, which is if it was a sure thing, then you wouldn't expect a premium. So, not that it's pleasant to go through, and I have empathy for everyone in the room who has clients asking, when is this thing going to turn? I mean, I see it in my own account. And it's not particularly, it's disappointing, but it's not unexpected. And I say that because at Dimensional, we expect a positive value premium every single day. It's hard to understand why you would pay a higher price and expect a higher return. But just like the equity premium, where there's a great reason why you should expect a positive equity premium every day, who would invest in equities otherwise? We've seen long periods of equity underperformance. I believe the longest period was 17 years, so we're not quite there for the value premium yet. But it doesn't make it any easier to go through. So I think some of the ideas there are, how do you make sure you're smoothing out the ride, making sure that you have multiple ways of adding value so that you can make sure that if one thing isn't working, and you should actually expect one thing not to work pretty frequently. So if you have, for example, 4 premiums that you're mixing together with the volatility of size, value, profitability, for example, about half the time, one of them is going to have underperformance, a 10-year underperformance. If you, for dimensional funds, if you had a global portfolio, the equity portfolios, for example, those are market-wide, they push on all of the premiums, you still have outperformance relative to a MSCI equity. So, and that's because there's lots of different ways that we're trying to add value. So I absolutely sympathize. I really hope that it's going to be over soon. But, you know, what I say to clients is, here's all of the evidence. It's not something unusual. I can't tell you when it's going to turn, but all of the data and evidence suggests that it should be positive, and there's no reason to expect it not to be on the go forward.
Yeah, and I think for us, the diversification beyond just value is critical. I think it's important because the factors are diversifying to one another, so you can have a higher expected return in the portfolio at aggregate if you can reduce the drawdowns. But also, again, I just go back to the fact that it's most important for you to match the investment horizon in your clients' portfolios with their actual investment horizon. And if it's not 15 years, then that shouldn't be the only thing they're driving returns. And so for many of our clients, they need those balancers because they can't continue to wait.
Good. Questions? Can you talk a little bit about mutual funds and ETFs? I know you touched on it a little bit, Holly. I would love to hear your thoughts, Marlena, implementing these factor strategies, mutual funds versus ETFs, and tax efficiency, as well as, you know, what are the things that advisors should consider when they're deciding between using an ETF or a mutual fund?
I mean, I think that the underlying investment strategy and how it's being executed is actually far more important than the investment vehicle itself. I do think that there's at least the benefits that we hear from our clients are primarily with regards to tax efficiency or intraday trading, where for clients that are dimensional clients, you know, those things don't seem to be, at least the intraday trading doesn't seem to be a high priority. When you actually look at the data, the tax efficiency numbers are quite similar. So those are the things that for us kind of tilted, at least for now, still in favor for mutual funds, where we have a lot of flexibility to be able to have a daily process, be extremely well diversified, because across our global core portfolios, if you're looking at more than 10,000 securities, having those tight spreads all of a sudden becomes potentially more challenging. So having a 10,000 security portfolio and knowing that you can go in at NAV at the end of the day seems to be effective for most of our clients.
Yeah, and I think for us, I alluded to it a little bit at the beginning. We're vehicle agnostic. I mean, we have an enormous ETF franchise. That's more client preference than anything else. We have many of these factor strategies in mutual fund as well, and have virtually no demand for that. And I think it's really, we have a big ETF franchise, so I think that helps. We're talking to people about ETFs a lot. I'm not going to ignore that fact. But I really think that it's the tax efficiency. It's a preference that we've seen with the potential for active funds to be packaged in ETFs. I mean, I think that's making a buzz because clients like the structure. Whether they're trading or not, I think the fact that they can gives a little bit of comfort, and it certainly levels the playing field when you can execute very close to NAV in the ETF, and you can get NAV in a mutual fund. They're almost the same now.
Great. Other questions, audience? Question back there? Yeah.
I'll ask a question. So how do you combat the question if you have someone sitting there say, well, in essence, what you're doing, aren't you really being active managers? So, basically it started out as passive investing or pure indexing. And then everyone got into indexing and created an index fund following Vanguard. That's like, okay, well, we got to create value. So now it's, okay, well, let's start exploiting different areas of the market. So we'll do factor-based. And then you're making, for lack of a better word, bets or tilts towards value small and doing this. So when you're making these judgments and tilting portfolios, differently than what the market as a whole, instead of just capturing market returns, aren't you in essence then making active decisions? And is that any different than someone who says, well, hey, let's just look at the economic environment, take a bottoms-up approach, invest in good companies, and go that way? So, I mean, how would you address that? Because I have people in the business that factor-based investing, and they're still making decisions, and it's active investing.
Yeah, so we believe that every investment decision that is made is an active one. Whether you have home country bias built into your portfolio or not, whether your clients have directed you to or it's your own outlook, that's an active choice. Anything other than market cap weighted, ACWI, IMI, so large, mid, and small, is an active decision. So we believe that every one of our clients is making that active bet. So yes, I think in many ways for us it's a democratization of what was predominantly or historically an active management strategy. In fact, I would guess that dimensional, the launch of kind of smart beta as a concept and that these are all indexed now probably makes you cringe, because it's not that something has fundamentally changed, it's just that we have packaged them in a way that is able to deliver the returns far more efficiently than active managers of yore. I think gone are the days, or soon will be gone the days where you have a large cap value active manager who's delivering almost all of the same securities as the Russell 1000. You know, we consider that closet indexing if you're basically charging 1% for the index. Those types of managers are going away and they're starting to buy factor products. And so I think of it more as a democratization than as a kind of a new way to exploit something in the market.
I think we absolutely concur that there's decisions to be made in investing all the way through. So, and all of those are active decisions. I mean, dimensional is certainly, I mean, if you ask me, I would call dimensional an active manager. And I should certainly hope so, because we do a lot of work in research to figure out how to achieve expected outperformance relative to a plain vanilla market index. I will say that we also think that the market portfolio is a great investment vehicle. It's low cost, it's well diversified, and if that's your investment goal is to match the market, then that sounds great. That's not Dimensional's business. Our business is meant to pursue expected outperformance relative to market indices. The way we do it, though, it does all center around our investment philosophy, which is we do think that the market price is going to be, it's the best information aggregator there is. So the ways in which we might deviate from the market all have to do with what are market prices telling us about expected returns. Because if you think that different securities should have different expected returns, then all of a sudden the question is not, let's just achieve market rates of return, but what's the most reliable, robust way of identifying those differences in expected return, and how do we then try and allocate more of our investments to those areas of higher expected returns. But we don't do it in a way where we are trying to figure out what's overvalued, what's undervalued. We think everything is fairly valued. And for us, that definition means it's really hard to guess whether a price is too high or too low. And that all of the information there is out there is embedded in this market price. So our job as a money manager is to figure out how do we extract that information from market prices. And that's where we get value. That's why we think securities lending prices, the fees are just another price, will tell us about expected returns. And we want to use that information. So we're active, but in a different way than typical like stock picker or bottom-up fundamental manager.
Great, other questions? Got a few more minutes here. Like, just to wrap up, I'd be curious, what do you both think the future is of factor investing? I mean, with so many factors being discovered, what are some of the innovations that you think we'll see in the coming years?
I can go. I'm sorry. I actually think the innovation is limited and limitless.
Okay.
And so what I mean by that is it's not our expectation that we'll continue to discover a whole bunch of new factors. But what I think always is evolving is how you measure those factors. What asset classes do you bring those factors in? Fixed income is a great example. Today, far more assets are managed actively in bond space than passively. We have not seen yet the same revolution in indexing your bonds that we have seen in equities over the last few decades. And I think it's in large part because of the opacity of the market. People believe that their active manager can deliver better returns. We would say your active manager is really applying a credit screen, which is kind of like a quality tilt, and then they're probably looking at a wider options adjusted spread. They're trying to deliver you some sort of value in the bonds that they pick. It's the same extension of factors, but without the democratization to index yet, investors haven't quite embraced them. And so I think how you think about measuring factors, so extending beyond historic accounting measures as accounting rules have changed and the way companies are run has shifted, that's the type of innovation that I believe we'll continue to see.
Yeah, I think that I would actually really strongly agree where I think that the kind of revolutionary days of brand new factors being discovered is kind of past us. I know I'm making a huge prediction there, and
It's going to happen in the next 20
That's
years.
but now it's more evolutionary.
Yeah.
So it's how do we continuously improve? And I do think that there's aspects that have to do with deepening our understanding of the drivers of expected returns. But then there's also this whole separate camp of how do you implement them? And how do we make sure that we're capturing every single basis point there is to capture for our clients? And that's not necessarily factors. That's how do we get more efficient about pulling information in, getting it into the process, making sure that we're being as stingy as we possibly can when it comes to cost. Those kind of things in the end also impact returns.
Well, I also think, one thing we haven't really touched on at all is the fact that academic research that is the underpinning for all of this, that is probably quite stable and not likely to change revolutionarily, at least in the foreseeable future, it all happens in a vacuum. None of it is actually implementable, right? All of these portfolios are traditionally long-short portfolios, no transaction costs, no market frictions. This is why people say, yeah, momentum worked in the research, but you can't possibly implement it, because we have all of these frictions in real life. I would disagree with that one, but the reality is when you talk about our portfolios, when you talk about Dimensional's portfolios, they're long-only investments. And they're actually buying securities. So we have to think differently about the metrics that we use in real life versus what the research uses, because our set of circumstances is different in real life than the research set of circumstances is. And so I think as we continue to see factors extend to new asset classes, extend to new segments of the market, and you think about China, for example, small cap investing in China and just determining quality when you have a lot of state-owned enterprises is very challenging. You might need to adapt how you measure quality, but it doesn't mean that quality doesn't exist there. And so I think this concept of adapting the research and how we implement factors is something that we'll continue to see evolve.
Great, thank you. Anything else? If not, we're out of time. I would add, before we wrap up here, that it can be daunting. All of the factors and the research and the new products that are rolling out all the time out there. Working with a firm like us, you know that you have the investment strategy team behind you. We're looking at this stuff all the time. We're constantly in contact with Dimensional, with Blackrock, with other firms out there. We're reading the literature, the research. So, rest assured that as you're navigating, you have a partner that's standing behind you that can help you navigate these waters. So, with that, Marlena and Holly, thank you very much.